Welcome to The Explainer. Today, we're pulling back the curtain on something you probably think you already know, the Exchange Traded Fund, or ETF. But here's the thing. Beyond that simple basket of stocks idea, there is this hidden mechanical genius at work, and today we are going to break it all down. So here's our game plan. We're going to start with the basics, then dive straight into that hidden engine room. We'll uncover why their liquidity is so unique, how the price stays fair, what advantages this gives you, and of course, the risks you absolutely need to be aware of. Okay, let's dive right in by starting with what most of us already think we know about ETFs. This question right here, this is really the whole mystery, isn't it? It's a paradox that trips up so many investors. You look at an ETF, you see that it barely trades any shares all day, and yet your broker can fill a massive order in a split second. How is that possible? Well, the answer lies in this unique structure that we're about to uncover. You know, most of us are familiar with these differences, right? ETFs trade all day long, just like a stock. Mutual funds, they get priced once at the end of the day. ETFs are also way more transparent. But while all that is true, the real magic, the secret sauce, isn't just that you can trade them all day. It's what's happening completely behind the scenes. All right, now for the cool part. Let's head down into the hidden engine room. We're going to pull the cover off this powerful, pretty much invisible mechanism that fuels the entire ETF world and meet the key players who make it all happen. So meet the main character in our story, the Authorized Participant, or AP for short. Think of these guys as the crucial middlemen between the ETF itself and all the stocks it holds. They're usually huge institutions, big banks, and they have a very special deal with the ETF provider. They are the only ones who can actually make or break ETF shares. This process is called creation, and you can seriously just think of it like a factory for ETFs. So when a lot of people want to buy an ETF, the AP steps in. They go out into the market and buy up all the individual stocks the ETF is supposed to hold, they bundle them all together, and they deliver that bundle to the ETF company. In exchange, they get a giant block of brand new ETF shares, which they can then sell on the stock exchange to people like you and me. So what does this whole factory thing actually mean for you when you hit the buy or sell button? Well, it means that the number of shares you see trading every day, that's only half the story. It creates this massive, hidden pool of liquidity. And this is exactly why just looking at the average daily volume can be so misleading. That number only shows you the activity on the surface. It tells you nothing about the deep reservoir of liquidity that's available right underneath. Okay, so this is the crucial takeaway. An ETF isn't just as liquid as its own trading volume. It is actually as liquid as all of the stocks it holds. See, the trading you and I do, that's the secondary market. It's what's visible. But if a huge order comes in, the AP can tap into the primary market by creating brand new shares. And that liquidity is based on all those underlying stocks. And that right there is the answer to our paradox from the beginning. But that's not all this dual market structure does. It also serves another incredibly important purpose. It acts like a powerful gravitational force, constantly making sure the price you pay for an ETF is fair and tied super closely to the real value of its assets. Let's just imagine for a second that a really popular ETF gets a huge surge of buyers. All that demand can push its market price a little bit above the actual real-time value of all the stocks it holds inside, what we call the net asset value, or NAV. So now the ETF is trading at a premium. This is where our friend AP becomes a kind of market superhero. They see this tiny price difference and they smell a low-risk profit, which is called arbitrage. So what do? They buy the underlying stocks at their cheaper true value, they use them to create new, more expensive ETF shares, and then they immediately sell those overpriced shares on the open market. That very act of selling adds more supply, and boom, it pushes the ETF's price right back down towards its true value. And of course, the exact opposite is also true. If the ETF starts trading at a discount, APs will swoop in, buy the cheap ETF shares, and redeem them for the more valuable stocks inside, which pushes the ETF price back up. This arbitrage mechanism is a constant, self-correcting force that keeps that ETF price honest. Okay, so it's a really clever system. But why does all this complex plumbing matter to you, the long-term investor? Well, because this unique creation and redemption mechanism leads to some huge advantages, especially when we talk about costs and taxes. The secret sauce here is something called an in-kind transaction. Instead of using cash, the APs are trading a basket of actual stocks for a block of ETF shares.
Because the ETF manager isn't constantly forced to sell stocks for cash to pay investors who are leaving, it doesn't create a bunch of capital gains that get passed down to all the remaining shareholders. This is a massive reason why ETFs are famous for being so tax efficient.
Of course, it's not all sunshine and roses. While this structure is incredibly powerful, it isn't foolproof, and it is so important to remember that not all ETFs are created equal. We've got to talk about the risks. So first up, you have tracking error. This is when the ETF doesn't perfectly match its index, usually because of fees. Second, even though that arbitrage mechanism is great, the gap between the market price and the NAV can get wider during times of extreme market stress. And finally, less popular ETFs can and do close down, which could force you to sell at a bad time and maybe even create an unexpected tax bill.
And then there's a whole other category of risk you need to be really careful with: products like leveraged and inverse ETFs. Now, these are designed to deliver a specific result, like 2 times the index's return, but only on a daily basis. Because of how they reset every single day, their long-term performance can be wildly different than what you'd expect. Regulators warn this can lead to major losses, which makes them a really bad idea for most regular investors.
So the next time you look up an ETF, you're not just seeing a ticker symbol anymore. You're seeing the tip of an iceberg. You understand that there are 2 layers of liquidity, and this powerful arbitrage engine working tirelessly behind the scenes to keep things fair and efficient. And knowing how the machine actually works, well, that empowers you to be a much smarter and more confident investor. Thanks for joining us on The Explainer.